All right, so recently I've been doing some research, going through screeners about mid cap and small cap companies that I potentially will be buying. Because if you look at the market, the mid cap and the small cap areas are the most undervalued right now, at least compared to large cap and mega cap. Specifically small cap, but this would technically more or less be a mid cap company. This is WTS, Watts Water Technologies. Now, I haven't started buying this company because I want to wait for a pullback because it's basically right at its 52-week high. 199 is currently at 193 and change. So again, $6.46 billion company. They have a dividend, which I'll get into. The free cash flow yield is 4.8%, which is solid. Let's see what they do before I get into it. Engages in the manufacture and provision of products for water conservation, safety, and flow control. Its product include residential and commercial flow products such as backflow preventers, water pressure regulators, temperature and pressure relief valves, and leak detection products, heating and ventilation, and AC and gas products. So again, that's basically what we're talking about here. Let's get into the company and we will go from there. So if we look at analysts are actually not super bullish on this company. But again, like I say, it is near a 52-week high. Again, that's why I'm looking to wait until it pulls back. I'd say into the 170s, I'd probably start to pick it up. And I'll get into that. So again, analysts, 11 have a hold, 5 have a sell, 1 has a strong sell. So if anything, they're actually slightly bearish. But again, analysts, nobody really goes off what analysts say. So the dividend I'll get into later. Financial health, again, current ratio of 2.74 is very, very good. They're not perpetually issuing shares. I'll get into that. The growth is solid, right? I mean, operating cash flow, net income are going up a lot. So again, they're fairly profitable. Management does a very, very, very good job of this company. Again, return on invested capital of 23% is very, very, very impressive. Return on equity, 21%, also impressive. If we look at the profitability, again, that's pretty solid as well. It's not great, but it's pretty solid. If we look at its valuation, again, current PE, 23.48, 5-year average, 26.6. The price of free cash flow, 20.72, 5-year average is 25. So again, they are below that number. Right, so based on current levels of earnings, they are undervalued. But if those earnings comes down a little, which is looking like what's going to happen, at least based on what the analysts are saying, the valuation will go back up a little bit, which again is why I'm looking for it to pull back a little before I build a position or start to build a position. So again, if we look at the balance sheet, again, 75% total assets versus 25% liabilities, that is very, very good, right? If we look at its metrics here, again, they're not the most profitable company in the world, but the one thing that they are is very, very, very consistent, right? If we look at their operating cash flow margin, it's been between 9.8% and 15% for the last 7 or 8 years, right? So again, they're fairly consistent there. Like I say, they're not the greatest you'll ever see by any means, but they are consistent, which is good to see, right? If we look at their cash flows here, again, free cash flow, look at the free cash flow growth over the last little bit. I mean, going back 10 years, I mean, 2013, 90 million. Now they're up to 195. So again, they've roughly doubled, right? So they're not like a crazy big grower, right? They're not a crazy big grower, but they are growing nicely, which is what I like to see. And again, two other things that really caught my eye here as well is, again, they're a company that has not taken on a significant amount of debt since 2016, which is really good to see. If we look at shares outstanding, again, they haven't issued a share since, at least 2014, actually 2013, right? So it's been at least 10 years before they've issued a share, and every year since then, they've bought back shares, which is exactly what we want to see as investors, right? If we look at the dividend, right? Let's look at the dividend, which is another thing that I really like here. Again, current yield only 0.74%, but again, they're growing that 11% per year, and the payout ratio is only 15%, right? So they have a lot of room to grow, and they're going to keep raising that dividend, right? I mean, look at this growth is very, very nice. I mean, if you go back 10 years, you got over 3% yield on cost, If you go back, let's say 20 years, you have about a 7.5% yield on cost, right? So those are the kinds of dividend stocks that you want to invest in, right? People get too caught up in a lot of these companies that are not growing at all. The cash flows are not growing, but yet they pay a 5, 6, 7, 8% dividend. But the thing about that is that it's irrelevant if you're getting no share price growth, right? And not only that, the dividends are not even sustainable, right? So you really got to keep an eye on that when it comes to dividend stocks, right? If we compare to the S&P here, they've always outperformed the S&P, right? I mean, if we go back basically any point in time here, they've always outperformed the S&P, right? So that's something to keep an eye as well. This is a company that consistently outperforms the market. The last thing I'll get into here is the valuation. If we look at the valuations, if this would load. Okay, so this is the valuation chart going back 10 years here. If we look at the free cash flow per share, that has grown 13% per year. Operating cash flow has grown 10% per year. And if we look at the growth rate to the valuation, well, it's grown 2.5% per year and 4.3% per year. So ideally, we want that to be not growing at all. But the actual hard returns, it's coming almost a very vast majority of that is coming from actual growth, right? I mean, let's go back 5 years just to see, just out of curiosity here. So if we go back 5 years, it's actually even better, right? So this company is growing actually faster over the last 5 years than the past 10 years, which again is a very, very good sign, right? If we look at the average price to free cash flow, we are looking at 22.1. The average has been 28, right? Average price to operating cash flow, 20.7. The latest, 19.07, right? So, like I said, if anything, this company is a buy where it's at right now. But I'm going to wait until it pulls back a little bit. If we get a 5%, for sure 10% pullback, that's when I'll start to hop in, right? And if we look at let's look at the share over the last little bit here. So if you look over the last, let's say, month, right? I mean, it was in the lows 170s. In fact, October 27th, it actually went below that. So this company actually went up a lot over the last month. So again, if we go back to the 170s, that's where I'd be buying. And if it went below that, that's where I'd start to be a little bit more aggressive. So again, that's just my outlook on this company. Like I said, I think that if you're looking at companies that are undervalued in today's market, specifically you're looking at a lot of small cap and a lot of mid cap companies. But the one thing you have to be careful of, especially for small caps, is a lot of these companies are not making money. And again, you got to be very careful with companies that aren't making money, because things can go from really good to really bad very, very quickly, right? So that's something to keep an eye on. So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.